In this episode, we will discuss the performance report. If we use a flexible budget within a performance report, we will end up with better results than using the original budget. Once the budget is flexed to the actual level of sales, the flexible budget performance report is used to compare actual results for a period to the budgeted results generated by a flexible budget. This isolates the cause of variances due to cost control, removing the level of activity differences as the cause of any variances. So if we were to prepare a flexible budget performance report for ABC Company, their actual results were 12,000 units. The originally prepared budget was based on sales of 10,000 units. That original budget at 10,000 units was assuming a selling price of $10 per unit, variable costs of $480 per unit, and total fixed costs of $40,000. By taking the budgeted per unit revenues and expenses and flexing those to a budget at 12,000 units, we would take the budgeted level of activity, 12,000 units, multiply by the budgeted selling price per unit, to get the budgeted revenues on a budget activity level of 12,000 units. 12,000 units times budgeted $480 per unit variable cost gives us the budgeted variable cost for 12,000 units sold. Fixed cost would be the same whether we were budgeting for 10,000 units or 12,000 units, because fixed costs are fixed. They do not change as our level of activity changes. Thus, what we can now do is take our flexed budget that's based on sales of 12,000 units and compare it to actual results of 12,000 units. Now, when we compare a budget revenue of 120,000 to actual results of 125,000, we can see that the dollar amount of the variance, or the difference between actual revenues and budgeted revenues, $5,000, favorable, because the actual revenues were greater than the budgeted revenues. We earned $5,000 more in revenues selling 12,000 units than what the budget had expected us to do. For variable cost, our actual variable costs were $59,400 compared to the budget of $57,600 for selling 12,000 units, an $1,800 unfavorable variance. Unfavorable because our actual costs were greater than what our budget says our costs should have been. We can do this line by line. Revenue variances are favorable if the actual revenues exceed budgeted revenues. Cost variances are favorable only when the actual costs were less than the budget. If our actual costs are greater than our budget, it is an unfavorable variance. What we're doing by using a flexible budget to compare to our actual results, we are seeing that the cause of these variances has nothing to do with the fact that we sold more than the budget, because we've taken that cause of the variance out. The cause of any variance is solely due to the price per unit being different than what the budget had planned for.